Well, hi, Benny.
Good morning.
How are you?
10:59. This is the earliest you've ever been for anything in your whole life.
I am so proud of myself. You don't even understand.
That's not true,
I
actually. I mean, there's a lot of people on this call. I'm just putting your laundry out there, but you were like 6 minutes early to the Real Producers event yesterday.
I know. I know. You guys, everyone who's on the call, I have this chronic habit of being late because I'm like usually booked, as we like to call it, back to back to back. Either that or I have a horrible time managing my time. I'm not sure which one it is. It might be a combination of both. But so we have this little running joke between the two of us that if I can make it somewhere on time, I deserve a cookie. So today and yesterday, I get a cookie.
Yes, I have a whole box of Girl Scout cookies. So
We like that. We'll give it a few more minutes, you guys, to get started. Hi, Troy, Michelle, Eric, Jennifer, Dawn, David, Bob, Benny. Thank you guys for joining. I think it'll be informative. Well, I know it'll be informative. I'm the one talking about it. We'll go ahead and get started, you guys, at around 11:03. So I'm just gonna put myself on a quick mute, and then I'll jump back in here in the next 2 or 3 minutes. Just give people a little more time to join. I see lots more people joining. I really appreciate it. Darlene, Eric, Michelle, Taylor, all these names. It's awesome. Cliff, thanks for joining us.
Yes. Hey, Noah. Good morning.
How are you?
I'm doing good, buddy. How are you guys?
Oh, doing great.
Wonderful.
is that the Cliff Cox?
Yeah, Benny, my man.
What's going on, buddy?
What's going on, man? How are you?
Good, busy,
Good.
which is always great news.
Mm-hmm.
The mortgage business is kind of crazy right now, you guys. Wonder what it's like for us, our realtors out there. I think I know the answer.
All right.
All right, you guys, we'll give it 60 more seconds to give more opportunity for more people to join. I believe this call is being recorded, so we can share it later, just to make sure that everyone has the opportunity to learn a little bit more about our view on the mortgage market and where rates are headed and how that impacts everyone's business going forward. All right, you guys, we're going to go ahead and get started. I appreciate everyone that joined the call. With us today, we have myself, Noah Rosen, Cross Country Mortgage Business Development Manager, and the wonderful Benny Scalaro, Cross Country Mortgage Business Development Manager, and the wonderful Cliff Cox, Senior Loan Officer here at Cross Country Mortgage. And, we like to schedule these calls at least once a month or as often as we can, to really chat with our agents and our market centers about where the mortgage market is heading, right? So we did this back in 2020 a lot when Corona first hit, and there was a lot of anxiety over what was happening in the market. And now that rates have started to go up, and we've seen it melted as early as the end of last month. We want to make sure that you, our partners, understand that we are here to help guide you, problem solve with your clients, and just make sure that everyone is given their fair chance at a good loan, conscientious financing, and get them into the home that they need. Because at the end of the day, we're not selling a mortgage, you're not selling a property. We are helping clients get into homes, and it really impacts their personal lives. So the format of today's call, I'm going to go over some talking points, and then I'll have Cliff and Benny chime in if they'd like to add any commentary to what we're discussing. The information that I'm going over was compiled by the three of us, so it's going to be cohesive across the board here, and then we'll open it up to questions afterwards to give you guys a chance to ask questions and maybe address concerns that you may have, so that we can talk through those things. So without further ado, let's jump right into it. As I mentioned, rates have started to tick up. The opinion of this is that, as the market reacts to inflation and the unrest overseas and the stock market overall, obviously the Fed, who is not directly responsible for mortgage rates, but does control a large portion of the US economy and how that impacts things like interest rates on mortgages, credit cards, car loans, et cetera, begins to influence the market, pushing rates up. There's a lot of unrest from what I can feel from agents thinking, oh gosh, is this going to completely tank my business? Or what happens to our clients, and how does this impact their ability to buy? Well, I'm here to tell you the business is as strong as ever. And while nobody has a crystal ball, what we're seeing with the rates today is really where rates were headed had coronavirus not happened. It feels more shocking because you have this extreme drop in rates that we saw in early 2020, and then a very quick increase in rates here just at the beginning of this month, end of last month. So it's going to feel very shocking. But to put it in perspective, had things just kind of kept going the way that they were going, this is probably where we would have found ourselves. Now, that's a nice thought, but how does that impact the daily lives of your customers, and how does that impact your business? Well, mortgage rate increases can slow the market down a little bit, but customers still need to buy and sell homes. And as long as they qualify at the pre-approval amount that they were previously pre-approved at using, the previous market's rates, they should have no issues, because realistically speaking, even at the higher interest rates, which we'll go over some averages here in a minute, in most cases, it's really only impacting a customer's payment by maybe $50 or $60 a month for every, $100,000 to $150,000 borrowed. So for some customers, that's a drastic change, but for most customers, it's not as life-changing as one might think, and something we can definitely work to control, not only through offering slightly lower than market rates, but also by helping them with the mortgage-related expenses and helping them find better deals there as well, such as less expensive homeowners insurance, helping them understand the benefits of maybe paying for mortgage insurance upfront instead of a monthly policy, an upfront policy, which helps to reduce their monthly payment, so forth and so on. So there are options out there for clients. But again, in general, rates have gone up across the board. And as I mentioned, it's important to understand that where we're at today is really what we believe would have been the market had things just continued on their path without the interruption of coronavirus. One thing I want to point out is that customers probably will see lenders advertising lower rates online or just even at their local bank branch. You guys have heard me talk about this before. It's something that we really preach day in and day out because it's true. It's important to note that any rate that's advertised until it's locked in, whether high or low, it does not in most cases show the costs for that rate. And so it's important for you as realtors to not only educate your customers, but support what your lender is saying. And I know you guys do that day in and day out, but helping your customer understand that just because something is advertised does not mean that that explains the full story. And so for instance, if one lender is saying, hey, your interest rate is going to be around 5.5%. And again, we'll get into some averages here in a minute, but if you're going to be at 5.5% or 5.75 or something like that, and then they see advertised online or just on a billboard or advertising inside their local branch an interest rate of 4.25 or 4.5, customers don't understand that that can come with an extremely high amount of points and costs. For customers willing to pay that, obviously any rate is available to any customer, relatively speaking, if they want to pay. But it's important to educate your clients that, especially in this market, as it becomes more and more competitive and lending companies really try to manage these rates and not lose customers through attrition, the advertising will become more and more saturated, and the message could be skewed, which is that rates have gone up, and if something doesn't look right, chances are it's not right, and more than likely they're going to experience some significant costs. So we have those conversations with your customers daily. It's not a conversation you need to feel the responsibility to have, but as a lender and as lenders, it is so much more impactful when you as the realtor kind of back us up on what we're saying, knowing that as Cross Country Mortgage, we will generally always be able to meet or beat whatever another lender is offering if we are not already better. But again, we would want a locked loan estimate from the other lender if there's a competitive offer on the table, so that we can help the client walk through any auxiliary fees that maybe weren't disclosed to them on the front end. So to kind of go over some general market data on rates, and this is a question. Yes, sir.
I just want to cut in before you move on to the next thing.
Sure.
Just as an example to support what you were saying about the rates, there is, I don't know how many people listen to sports talk radio. I listen to it every day. Rocket Mortgage has this commercial on 92.3 that I listen to that drives me crazy, that promotes refinancing or purchasing a home at 2.875%. And it's still going now. And at the very end, at high speed, somebody gives the disclaimers, and it just says, based on the average market rate as of December 12th, 2021. So they're just using outdated data on purpose to get people to call them so that they can get them moving. So just as an example of how some places do that kind of stuff, that's one example that, I mean, I literally hear it almost every day.
I love that, Benny. And you guys, as a company, as a team, as a branch, we're not in the business of throwing mud, right? We don't point out, oh, we're better than this person or better than that. But facts are facts. And really what Benny is showing as a real world example is that, not all lenders are created equal. And we know that. As a company, as a team, as a branch, our goal is not to sell a loan. Our goal is to advise clients on their options, right? And what we can offer to them, and do so in an equitable way that's not salesy. And what you'll find is that there's other companies out there, as I'm sure you guys are aware, that really are just in it for the sale. And they don't really care that the customer is going to incur thousands of dollars in cost to attain a rate they've advertised. And in some cases, they may not even lock in that loan or disclose those costs until a couple weeks into the transaction, knowing the customer has the money to pay for those costs, and simply just not telling them what those fees are until it's kind of too late to start shopping or switching. So, just be cognizant of that as you navigate this with your clients. And please, please, please understand that when we say, look, you're always welcome to flip a client to us or have us take a second look at their deal, we're not approaching it from a sales perspective. We're approaching it from a how can we help perspective. And if the deal they have with their current lender is genuinely better than what we can offer, we'll be honest with them to that effect. But in most cases, it's not. And even if the offer they have is slightly better than just the standard pricing for our company, we're always willing to review the option to flip them to us, as part of the partnership we have with the Market Center and with you individually as agents. So, Benny, I think that's awesome feedback. I really appreciate you for jumping in with that because it demonstrates what we're talking about. So as far as interest rates are concerned in general, this is a question we get all the time. What are the average interest rates? Well, prior to this jump, okay, rates were in the mid fours, mid to low fours. And right now where we're seeing things track is in the mid fives. Okay, so I'm going to go over some market data that just gives you an example of what the average interest rate would be. And by the way, this is pulled directly from Google, so it's not our own company's analysis of the mortgage market. This is information that's available to consumers. It's neutral. It's not a sales pitch, and it's not something being advertised by ourselves or our competitors. This is just neutral information that if you Google current mortgage interest rate through Google and you go to their portion of the website, you'll be able to see all the information there. So as far as the data is concerned, customers with credit scores 720 to 780, okay, 5% down and 20% down, you're going to be looking at interest rates that are in the mid fives to high fives. Are you guys able to hear me if my Bluetooth is working?
Yep, that works.
Okay, awesome. Bear with me 1 second here. Okay, sorry, my Bluetooth decided it didn't want to work anymore. But anyways, so we're seeing interest rates 720 to 780, 5% down. You're looking at 30-year fixed rate mortgage as of yesterday's data, 5.70%. Okay, so that's mid to slightly above mid fives. When putting 20% down, the buyer's interest rate generally actually goes up a little bit. That's something most people don't realize. The mortgage insurance that goes with a loan to value under the threshold of 20% to reduce or remove the mortgage insurance actually has a slightly higher risk category. So you'll find slightly higher interest rates, upwards of maybe 5.8%, 5.875. As it relates to customers with credit score 780 and above, you're seeing interest rates dipping down into the mid to lower fives, somewhere in the neck 5.7, 5.4, I'm sorry, 5.5 and 5.4 with 5% down, and then 5.5 and 5.7 with 20% down. The gist of it is, those are small incremental changes, 5% down versus 20% down, 720 versus 780. It's something we manage with clients, and those rates do fluctuate on a daily basis. So it's important to remember that when a customer asks you, hey, what is the average market rate? Well, one, as the realtor, it's not something that you need to have the responsibility of quoting your client. Obviously, you would encourage them to speak with their lender or to speak with us, but you can safely say that your knowledge of the market shows rates in the mid fives, okay? And then obviously, if they have concerns about that, they contact the lender, we can walk them through things. As it relates to FHA and government financing, it really is tracking to the same number, mid fives, low or mid to high fives, for customers with credit scores over 620. We will still finance clients down into the 580s. You'll find in this market that a lot of lenders who may have previously been offering financing to customers that are lower scored, so scores under 620, may pull that financing because of the high nature of cost associated with those loans. Cross Country Mortgage and our team and our branch has committed to not making negative changes to clients. We may come back to you and ask for assistance in some seller paid costs or various other remedies to cure high cost loans or high priced mortgages. But we always ask ourselves first before coming to you, what can we do to help the client? Can we issue a lender credit? Can we help them maybe select a higher rate? Are there other remedies that fix some of these cost issues for these lower scored borrowers? The point of it is we will continue to remain flexible and continue to offer financing to all customers, whether they're, on the lower end of the spectrum or the higher end of the spectrum from, an income, credit, or asset standpoint.
I just
Go
did a
ahead.
pre-approval last night, you guys, for a 579 credit score. And it was a little bit more down payment, but there wasn't any like weird fancy tricks that we had to do, but under 580 for FHA. And I'll be able to close it in like 25 days.
That's a great point. And, the gist of this, guys, again, not to be salesy, but just to say, hey, as realtors, it's not easy out there, right? You're in one of the hardest markets that we've seen in the last 20 years. If you're a buyer's agent, homes go on the market 50 showings later and, 20 offers, some of them cash. You have to find your buyer a house that not only they want, but that a seller will accept. So our commitment to you and to your market center and just to our partners in general is that we'll continue to stand by you and not only help customers attain financing on all sides of the spectrum, but also making sure that clients, whether they are lower income or lower credit score or high net worth, high purchase, high credit score, that each of those customers and their unique needs is finding a home and finding the right financing. And again, it is something that you want to be cognizant of, that as these changes go into effect, that you're checking in with your customers. If they're not pre-approved with us already, checking in with their current lender and making sure that this financing is still viable before you continue this search and put all your efforts into it. And if they say, by they, I mean the other lender, that the client no longer qualifies, please bring them to us. We'll review it. It doesn't cost any money. We can give them an answer as to whether or not that decline is a false decline or if it's genuinely something that they can no longer do, simply because we do not have overlays on top of the base policies for the mortgage investors, either conventional or government financing, which allows us to be more flexible. So just to wrap up here on the commentary before I pass the mic over to Benny and Cliff, if they want to add anything additional, and Ben, I really appreciate everything you've contributed so far. What's going to happen in the future? Well, we don't know. Nobody has a crystal ball. But if I was a guessing person, and I guess part of lending is a little bit of guesswork, I would say that in the next 30 to 45 days, we'll see things stabilize. Now, what does that mean? Does that mean rates are going to go back down to the mid threes? Doubtful, possible, but doubtful. My personal opinion is that rates will stabilize somewhere in the low fives to high fours, which is where they were pretty much at prior to coronavirus. And we know that those rates do not slow down the market, nor do they take customers out of the running to own a home. So while, again, we don't have a crystal ball, we can't say that this is exactly what's going to happen. My guess would be that things will start to level out and a lot of the fears that people have will start to be calmed, and this will actually positively impact your business because the customers that were on the fence, waiting for the market to slow down, waiting for house prices to go down, thinking that mortgage interest rates would go down, kind of got a quick kick in the pants saying, hey, look, you can't time the market. Rates skyrocketed overnight. If they come back down a little bit, that's really going to inspire these people to put their home search into high gear. So, but even if rates were to stay the same or continue to increase, we're here for you. We're here for your clients. And frankly, I don't see the market slowing down anytime soon. So, Cliff, Benny, do you have anything to add outside of what you've already contributed before we open it up to Q&A?
Yeah, I mean, there's a couple of things that I wanted just to kind of make sure and go over today, and thanks Noah for just going over everything you had already touched base on, in regard to this call, because I think it's very informative. It's very important that we're reaching out to each and every one of our agents here and just kind of just educating them and letting them know what we're doing with our borrowers, to get them in the position to just to buy and to be comfortable. I know recently, with with interest rates and everything, kind of going up as quickly as they have, and borrowers just having a lot more questions on, seeing what they could potentially be pre-approved for. I know myself, and I know a lot of members on our team have already gone through, our lists of borrowers that we already had pre-approved. And this is say back in, towards the end of last year or even the early part of this year, and just had to reevaluate things, make sure that, hey, we're going through each and every one to make sure that, is the borrower still going to be pre-qualified for, the price point that they're looking for, and what questions or what ways can they, to stick to that price point, or do they need to, lower things, or just an understanding and education, as I think is vital right now with, what we're doing as loan officers and educators to our borrowers, and just making sure that we're taking that extra step. And that's what Cross Country does. This is exactly what we do, everybody, is we really take the time to make sure that each and every client is put in the best situation possible. Now, I know that you'll see, things online in the market analysis of what's going on with, the economy. Is ARM loans going to start making a drastic comeback, or different type of option loans? Those types of loans are okay, but I really don't think that that's going to be the answer right now. I still think just keeping everything, with the fixed rate market, and just understanding, the true value of what the, each borrower can afford to pay and what they want to pay, and just making sure they have that understanding is going to be crucial, as we get through this time of, of market instability. So I know recently what I have been doing too is a lot of clients, in regards to points and things like that, really educating them on what points are, like, what does it do? Like, is it something, is it a recurring cost? Is it something that they, pay prior to close? Is this at closing? And just really letting people know and understand what points, can do, and, if it makes sense for them to do that, depending upon how long they even want to be in the house, or or what the purchase price point is, because points will be different based upon each, purchase size, as we all know, because that's all based on, loan amount. And so I have really been educating clients with that as well. If they do want to take the chance into looking into what a potential lower rate might be, is I go over exactly what that extra cost would be, that it's just a one lump sum cost, that's due at closing, that could potentially buy their rate down a little bit more to maybe where they feel comfortable, to kind of keep that payment monthly, within a, just a proximity of what's comfortable for their family, what they, had anticipating, making, each month as they, own this house. So, just things like that. We just wanted to make sure that we're going over that with each and every borrower, and helping them, with credit. I know I just recently had a very successful, credit repair class, just to kind of help, educate, some of the agents and borrowers as well. Just the importance of their credit. What's it going to do? Is it really going to, help with the needle here with getting myself in the opportunity to, get a lower interest rate or a lower payment? And it truly is. And we value the good credit score borrowers just as we do with the non-credit score borrowers, because we want to make sure that, if they're not able to get anything, and maybe at this time just due to credit issues, that we're educating them to and helping them get that up, and not just tossing them aside, because that's just not how we operate as a company, and what our vision is in regards to each and every homeowner having the chance to be a homeowner. I mean, it's a very important and a very exciting thing, to become a homeowner. I mean, especially what I see, what a lot of clients have been, paying, for rent these days, is that we're, getting them into a home, is could be life changing for them. And it's just, it's very, exciting to be a part of. And we really want to make sure that we're helping everyone getting into the best situation possible.
You guys didn't leave much for me. So I wanted to touch on Noah saying stabilizing in the next 40 days. I agree with all of that, but I just want to clarify what he means by stabilizing. While rates may come back down, and that seems reasonable, what's happening now is whether you ask us or any other lender, what's rates like? What are rates like right now? And everybody kind of doesn't know, because yesterday they were just falling off a cliff, like in a bad way. And today they're coming back a little bit, but tomorrow, who knows? And that is not a result of the lenders, but really the folks making the rates, the investors. Nobody really knows what's going on, which David, you asked what economic indicator has the strongest correlation to mortgage interest rates. Nobody, even in the government, has really any idea right now. Normally, you would say inflation, job growth, unemployment rates, things like that. You can kind of look at, but right now it's just kind of all over the place. So when Noah's talking about stabilizing, this sort of running with a blindfold for all the financial folks in the highest positions is going to probably stabilize over the next 30 to 45 days. So while we can't really give you a great answer right now to that question, we should be able to narrow that down in the coming weeks. In addition to that, because the rates are so volatile right now, one thing to just sort of prep for, and I know that on a real estate level, this is a little bit of a tough thing to take, but seller credits are going to be huge for getting some of the lower credit score borrowers approved because of the cost of the rates, the discount points. So just prepare yourself for that. Us at our branch across country, we are looking at that during pre-approval. So we'll let everybody know if there's something that's necessary or recommended, and we'll put that out there up front so there's no surprises. And then I guess transitioning into the question and answer period, David also asked one other questions about consumers encouraged to compare APRs and if that's still the case. So APRs are sort of an extension of the interest rate, and it includes fees and how they're amortized over the first, I believe, 5 years. So the fees are really something that you can compare now on the loan estimate, where if you've got your interest rate of 5.5, and then your APR might be 5.9 because of our lender fees and the points. But the lender fees and the points are in a very specific place on the loan estimate. So you can compare those apples to apples as well to see whose points and lender fees are more or less, which are really what anybody can control in lending. I don't know if that answers your question, but they can look at it, but it should lead them back to what are the fees that are causing that and how can we look at an apples to apples comparison.
That's a great point, Benny. You guys, all this detailed information, that I've given, Benny's given, Cliff's given, it's important for you to understand, right? And it's important as a professional to know what these things mean. And, based on your level of experience, this might be the first time you're hearing this, right? And for those of us that have been around for a long time as agents or as lenders, this may be something that's not even concerning to you because you've sold and been able to be successful in multiple different markets. Just as a general statement, at the end of the day, as I mentioned at the beginning of the call, what's important here is helping customers into a home or helping them with their real estate needs, right? It's a canned phrase, but saying, do you know anyone that wants to buy, sell, or invest in real estate? As the trusted advisor for your clients, what you can do to control the emotions around this market is help your clients take some of those emotions out of the process, which is that one, if they're working with your partner lender, and with Cross Country Mortgage specifically, we're going to do everything we can to control things to put them in the best possible scenario while we manage this market. And two, from us to you, our agents, we're here for you, right? If you have a concern, if a client has an issue, if you're trying to get something done, we're not our best when we're just helping the customer that doesn't need anything, right? Of course, we're going to ace that test. Where we really prove our value to you as a partner is when you actually need us to problem solve. And that's something that I believe we excel at, both as a company and as a team and as a branch, So I'd like to open it up to everyone on the call if you have questions to get some conversation started. So I'll open it up to your questions and then we'll kind of go from there.
If anybody doesn't want to ask vocally, you can also put it in the chat, and I'm monitoring that as well.
Yep. Yeah, please, guys, if anything, any concerns that you guys, may have or, want to discuss, yeah, feel free to let us know. And this is a great forum to be able to answer, questions or concerns that you guys may have, with this market being the way it is right now. So yeah, we're happy to help. So yeah, feel free. And remember, there's no such thing as a stupid question. So yeah, feel free to ask us anything you guys want. This is why we're here.
I'd like to pose a question to the group, actually. How many of you guys, maybe drop it in the chat or feel free to take yourself off of mute and just respond. How many of you have sold through a market that's a little more volatile? So I'm talking agents that have sold through like 2008, 2009, when things were a little crazier, or maybe, just going into 2012, 2013, when things were heating up a bit more. Interest rates were fluctuating a bit at that time as well. Do we have anyone on the call that has a tenure and sold through a market like that? And if not, that's fine. I think it might be interesting to hear some commentary from, our peers about how to sell through that market. One thing that I'll say, because I'm the old fogey around here, I've been around forever. Cliff, I think you've been around a long time too. And, obviously, one of the things that I think is most important right now is, as the professional, as the center of influence, as the person, party, whatever you want to call it, realtor, trusted advisor that your clients look to, even if you have personal anxiety about the situation, right? About the market itself. You have to keep that game face on, because your customers are going to be a direct reflection of how you react to things. I think everyone that I work with through Elevate and Legacy, and I think I can speak for my entire team, really does a great job of keeping their clients calm. And that's part of Keller Williams culture. Keller Williams culture has that abundance mindset, and we're not looking back, we're looking forward. And so during times like these, both when it happened with coronavirus, nobody knew it was going to happen with rates, and they went really, really low, and that stimulated the market like crazy. And also, in times like these where rates have gone up a bit, and, it could be kind of scary for people. As the realtor, as the professional, keeping your calm, not having knee-jerk reactions really sets the tone for the transaction. And then, of course, knowing that your trusted partner, in this case, Cross Country Mortgage, we're going to do everything we can to further that message and keep a calm tone. And we don't have a "this is what it is" attitude. We have a "what can we do, how can we help" attitude, and keep things positive and upbeat, and just help everyone navigate through the market. So I see, let's see here, was there anything in the chat?
Eric just asked the question, if we have any coverage for an appraisal that comes in less than the offer. It's not something the lender would have. Sometimes, you have it covered in the contract. But other than that, it's negotiation from that point.
Right.
And, really focusing on the comps but we have a very good relationship with our appraisal management company. So we're confident that the appraisers that are on their panel are receptive to, sending in additional comps that might support a different value. So that's how we sort of combat that, in addition to the negotiations, is having that relationship with the appraisal management company. But we're also able to ask questions for you guys directly, if you ever have those.
I couldn't agree more, Benny. And, Eric, it's a great question. I saw this meme on Facebook the other day, and it was like, hey, everyone's shocked at where the market's at, but the client wasn't concerned about guaranteeing an appraisal with an offer over 25,000, right? But then rates go up a little, and now they're really concerned. It's kind of six in one hand, half dozen in another, right? But the point here is that we're flexible. Do appraisals always come in at value? No. One of the conversations, though, that I have and we have on a regular basis, number one, is that we have a very good relationship with our appraisal management company, as Benny indicated. That does not mean we can impact the value. Legally, we are neutral to that appraisal, as we should be. And, we're looking for the value that the market will dictate based on the appraiser's opinion of the value. However, in the event that there would be a dispute or a rebuttal to a value, our ability to work directly with the appraisal management company is bar none. I've worked for multiple different mortgage companies in the past. I believe I found my forever home at CrossCountry, and one of those reasons is creative solutions to problems like appraisals that come in low. One side note I will make, though, there is a difference between a low appraisal and an appraisal not coming in at the escalated price, right? So I know that's semantics, but I think it's helpful for customers to hear that in negotiating the deal, especially if the client has signed appraisal gap coverage where they have to bring the difference regardless. And the tone is not if the appraisal comes in under their contract purchase price. The tone is not, it was a short appraisal, right? If it came in somewhere between the list price and the contract price, it's not a low appraisal. It is an appraisal that gave a fair market assessment to a client who knowingly escalated up in purchase price, sometimes understanding on the front end, or sometimes not completely grasping on the front end, that the choice they're making to escalate that purchase price is a choice, right, to win this home. And so I like to not say low appraisal if it's coming in somewhere between the purchase price and the list price. It's an appraisal that gives a fair assessment of the market value. Of course, we'll always be willing to submit any CMA that's available, validating the higher purchase price. But the semantics, they're important for the client to understand this was not a low appraisal. The property has value. If you're willing to pay for it, which you were at contract signing, that someone else probably will be willing to pay for it as well if you're concerned about resale. And by nature of purchasing that home at a higher purchase price, you're increasing, potentially the values for everyone around you as well, further driving home values up, which is a good thing. So, it's not a low appraisal, it's a fair market assessment. Now, obviously, if the appraisal comes in under list price, then yeah, that's a low appraisal, but there are remedies, right? 2 times last month with agents at Elevate, we had an appraisal that came in under the list or under the contract price, but $5,000 or $6,000 over the list price. And we were able to manage that with the clients and In both cases, neither client had to bring more money because the agent partnered with us on the front end and really instilled in the customer that it was important to come in with a higher down payment and really budget for that to accommodate for any shortages that may happen with their signed appraisal gap. And so in the end, logistically, neither customer ended up having to bring more funds to close. They simply just had a different loan to value because the value as appraised was slightly less than the contract price. So we're in it to win it. Creativity is one of the things we do. And sometimes it's not just about quote unquote fixing the problem we can see. It's about finding a creative solution to get the deal to closing. Okay. I hope that answers your questions. Do we have any other questions? We have about 15 minutes left on the call. Of course, I'm not going to keep everyone here if we don't have any other questions, but I want to make sure everyone has a fair opportunity.
Can you
to
explain points?
Yeah, Benny, do you want to take that one? I think your explanation is usually the best. I love the way you explain points and the benefits.
I'm sorry, Mary, you broke up. I didn't quite hear. I just heard points. And so I almost ran, but I figure if you want to repeat yourself, I'll help you out.
I was saying, if you can explain a little bit how points work.
Oh, yes. So points are, everybody just uses it like it's this common knowledge, but points is a financial jargon word. They're basis points, which is just a fancy word to say a percentage. And in mortgages, it's a percentage of the loan amount. And so what you use points for is to buy your rate down, which means you're paying to get a lower rate. And that translates obviously into dollars, but to sort of simplify it a little bit, every rate with a mortgage comes with some sort of cost. Now, in a very good buyer's market, that cost could be negative, where they're getting a credit back. It could be zero, which would be considered a par rate, which is the same as golf. It's just not giving money, it's not receiving money. Right now in the market we're in, when we're looking at the costs to the rates, all of them just have a dollar amount associated with them that would be paid at closing. So if you pick the highest rate available, which the last time I checked today for a conventional was 6%, whatever that percentage is, maybe it's 1% of the $200,000 loan. So that person would have to pay $2,000 at closing, along with all their other closing costs for that 6% rate. And then as you go down, let's say 5.5, the cost goes up by a percentage. And so maybe they have to pay $2,500 for the 5.5% rate. So just understanding that discount points are just the cost associated with each individual rate that the borrower is going to choose from. We actually guide them through what would be a good investment or a bad investment. When paying $20,000 to get a 2.875 rate is a bad idea, versus, maybe paying a little bit extra to get down to 5.25. But it's all a sort of a subjective formula that will guide everybody through and help them make the best decision for them. Some people want to pay less monthly, some people want to pay less at closing, but for you, the idea of points is just the cost that is directly associated with each rate. Did that help?
Yes, thank you.
You're
Yeah,
very welcome.
yeah. And that's right, Mary Lou. Benny explained it, pretty much perfectly. So when it comes to points, what we've really been educating borrowers on, not only if they do decide, to use extra funds to, buy their rate down or, cover the cost of the rate or whatever they would like to do. We make sure we let them know too that, it's tax deductible as well. It's a one-time thing. So basically at the end of the year, when they, or the following year, once they, they get their mortgage interest statement and some other their documents and everything when they do their taxes. Points initially when you purchase a home, can be used as a write-off. So we educate them along with that, as well as, talking them through too, the tax prorations and things like that that they receive, at closing too from the seller. I know I've had a lot of clients, that have the, enough money to cover their own down payment, closing costs and things like that. And then, the tax proration that they receive, at closing too on purchase transactions, that's extra funds that's coming from the seller. So we, educate them too that, hey, you're going to be getting an additional maybe $2,000 in tax proration. How about we use that to apply to use towards, the extra cost for the points to get the rate where they need to be. So there's lots of different things that we go over with each and every client to make sure, it makes sense for them financially, so they understand what their true cash to close is, when we do, have points that are involved. So yeah, great question. And it's a very hot topic right now that we talk with everybody on.
Okay, I guess the part that I didn't understand is if you put like 20% down, it can cost you more than putting less down. I didn't understand that part.
Oh, I can explain that. It seems very counterintuitive, right?
Right.
If you put down, so PMI or mortgage insurance protects the lender in case the buyer defaults. So the more you put down, the safer the loan is. But once you go from, let's say, 85% loan to value to 80% loan to value, that mortgage insurance, which covers the lender, drops off. And so it's sort of the same as it's riskier if you have car insurance or you don't have car insurance. And so as soon as that mortgage insurance drops off, it makes the loan a little bit riskier, although not too much, but a little bit. And so that affects the rates by a marginal amount. It's not anything crazy. It's not going to jump from 5.5 to 6, but the 5.5% rate could carry slightly higher dollar amount for points when you don't have the mortgage insurance on there. So once you switch from,
Okay. Thanks for explaining that.
To piggyback off what Benny was saying, as the lender, what we're actually referencing is the investor in the mortgage. So mortgage insurance in most cases doesn't necessarily benefit, say, the mortgage bank, say Cross Country Mortgage. We do in most cases service our own loans. So I want to make sure you understand that as a company, we're not penalizing customers for putting less money down. What's happening is, I've said it, I'll say it again, a mortgage is a mortgage is a mortgage. Most entities, banks, mortgage companies, brokers are receiving the money for funding of the loans they underwrite through the mortgage marketplace, whether that's through Fannie Mae or Freddie Mac, FHA, VA, or USDA. And so it is the policies of those investors that the lender must pass along, and that's how it relates to the rate. It's not something Cross Country as an entity is penalizing customers for. There was a question in the chat about, do lenders charge origination points? So while we have everyone on the call, I think it's important to understand that not all lenders are created equal, and how they disclose costs and points is different. And so that is why it's so important that if a customer is rate shopping, or if a customer has concerns about their rate, that they receive a locked loan estimate from their lender. And I'm talking about us first, right? Because we are not ashamed of the costs associated with doing a loan, because we believe they're fair and we list them in a way that's easy for a consumer to understand. But to answer your question, origination charges are the charges that a lender can, require a customer to pay to complete the processing and underwriting of the loan. Okay. No two lenders are created equally. Some lenders charge much higher origination charges, offsetting points, which then are disclosed as lower points on a disclosure to a customer. However, it is the total cost of the origination charges, both points and any lender fees, that we look at to help a customer understand what the better option is. So if lender A is offering, say, a 5% rate with 1% in points and a $3,500 origination charge, right? Not points, but $3,500 in origination charge with 1% in points on the purchase, or I'm sorry, on the loan amount. But lender two is offering 1.5% in points for the same rate, but with only $1,500 or $1,600 in origination charges. Who has the better deal? Lender two, in most cases, has the better deal. However, if the loan officer was simply just pointing out what the points are to buy the rate with lender one, then it would appear that they have the better deal with lender one, but they don't. Now, consumers are not educated on that topic. And so that's why we take the time to educate them on those topics and show them, hey, we're not inflating the costs of this loan. We're showing you what the actual costs are. We're willing to play as necessary and be competitive in this market through issuing lender credits when appropriate to be competitive, but that you really need to understand how lenders structure things, because in the end, most companies' goal is to simply sell a mortgage. Our goal is to sell a mortgage, but do so in the right way. And so to answer your question about origination charges, yes, most lenders charge origination charges. For lenders that do not charge origination charges, usually that's built somewhere into the loan itself, whether through a higher interest rate or through the discount points or whatever. And so that's where we can really come into play and help educate your clients on the way that lenders charge them money and help them cut through the smoke and mirrors to understand who actually has the better deal based on an analysis of their locked loan estimate. It must be locked because until a loan is locked, a lender is not required legally to show you their hand, and most lenders do not. We do, because we do not want to ever feel as though a client would have the wool pulled over their eyes. So we're very upfront with costs on the front end, which leads to much success on the back end, where we don't have customers saying, wow, we thought it was way less expensive, but somewhere along the way, there's all these extra charges we weren't aware of. So brand and reputation are very important to us, in addition to being creative and closing your loans on time and solving problems. So I hope that answers the question.
Hold on, Noah, can I summarize what you said?
Yeah.
So I want to go back to Mary's question where she asked about points for the rate. So, and I said points are just a fancy jargon for finance, that it means just a percentage, right? And so origination points, some lenders charge origination points, some products are required to have origination points, and states are all different. But in Ohio, for anything other than a VA loan, we charge origination fees because ours are fixed. So our origination fees are $1,640. But some other lenders you may see have origination points, which could be, 0.75% of the purchase price. So they're all the same thing. Some are just fixed and some are percentages, but that is the overhead for the lenders, and that's how they pay their people. So David, yes, some lenders do charge origination points, some charge origination fees, which are fixed, but both of those things are the same thing and go to the same place.
And we do not charge a fee to lock.
No.
David, that was a great question.
Yes.
We do not charge a lock fee, meaning that we are willing to give the customer that good faith locked loan estimate without trying to lock them in with upfront costs, because we just believe we're going to be able to offer them the right solution, both in service and in cost and in rate.
Yeah. And if we don't want them to pay us money because they found a legitimately better deal somewhere else, because that's not the right thing to do for the customer.
Right. Exactly.
Okay. Yeah.
Awesome. Well, you guys, if we don't have any other questions for the group, I really want to thank my partners, Benny and Cliff. I mean, listen, we're all in the trenches every day with you guys. But, I see Benny and I see Cliff, just face forward all the time. I know I'm not always in the office as much as I'd like to be, like physically in front of you, but I just have to hand it to them and thank them for taking the time out of their day to be on this call with me and just offer their insight, because each of us has a different perspective, similar views, but different perspective to bring to the group. And I want to thank you guys for taking the time out of your day. You're busy. You have things to attend to. So taking the time to listen to us, to educate yourselves, to be a better realtor for your clients and your business, just exemplifies why not only Keller Williams is an awesome brokerage that, well, I've always had a very close relationship with, but also just hats off to the culture of our 2 market centers, Legacy and Elevate. It's awesome. So thank you guys. Thanks to the leadership for scheduling this call at both market centers. We really appreciate it. And without any other questions, I'll go ahead and end the call and just thank you guys. Get out there, do your thing. We're here for you when you need us. Okay.
Thank you.
Thank you all.
Yeah.
Have a great afternoon.
Everybody.
Yeah, happy selling, guys. Let us know if you
Happy
need anything
selling.
at all.
All right. Take care.